Welcome to Next in Tech, an S&P Global podcast where the world of emerging tech lives. I'm your host, Eric Hanselman, Chief Analyst for Industry Research at S&P Global. And today, we're going to be looking back at the previous earnings season. And with me to discuss it is returning guest, Melissa Otto. Melissa, welcome back to the podcast.
Hey, Eric. Thanks for having me on. It's always fun to talk tech with you.
It's great to have you back. And we are on the other sides of not only the holiday season into the new year, but the other side of the earnings season as well.
Indeed. And it was a wild one this past earnings season. I mean, we certainly had out and underperformers. There were quite a few surprises.
Well, what were you seeing in the visible alpha data? And what kind of things stood out as, I guess, some of the highlights?
Absolutely. I think as we look across the earnings results and how stocks performed, it was pretty interesting to see that Alphabet, beat expectations, and that stock has continued to move higher. NVIDIA, interestingly, in the quarter delivered an inline quarter, but as we move into this final quarter of the year, what we are seeing is that expectations around Blackwell continue to ramp, and that estimates are continuing to grind higher, which does put some positive sentiment back into the AI trade overall, since NVIDIA is definitely considered one of the bellwethers. Amazon, really all eyes on that one because it's got two prongs to it. One is, of course, around AWS, how AWS is performing. But then there's this whole read on the consumer and, where the macro backdrop is going to send us in 2026. And I think, what we are hearing and seeing broadly is there's been a bifurcation in the market around, lower end consumers feeling more strapped while premium customers are spending more. And we are seeing more and more consumers buying online. There's a lot of data suggesting that online sales in general have moved up this holiday season. So I think that's like a broad snapshot. Meta and Microsoft, those have been more muted. I think we're waiting to see a catalyst on both of those. Not much activity in the data from our side.
Well, it's interesting bringing up Amazon. It's something that we were just talking with Cheryl Kingstone about some of the consumer data and some of the AI impact in consumer interaction with retailers. And she was bringing up the point that for the first time, one of the things that AI has done is started to shift a broader set of consumers into digital interaction. Because the history had been that you saw a significant break across generations for who is engaging digitally, who is transacting via digital channels, and that AI is something that actually has flattened that out, that you now have, because you've got conversational interactions, because you've now got a more directly interactive, the chatbots of old are now replaced with something that is fully conversational. And that really had started to bring in generations, raised generations, and the older segment of the population are now starting to engage in digital channels in much greater ways as well.
I mean, this is the power of natural language because it's just a matter of asking questions, and we can all ask questions. And some may argue that the older generation asks better questions.
Well, and perhaps the other thing that Cheryl's data is showing is that if we start looking at the level of concern with some of these engagements, the level of trust that gets imbued, those also start to ramp up. So it's interesting. We were just talking in the previous episode about the transition to agents and trust in agents, and are you going to let agents buy things for you and those sorts of things. There's still that level of skepticism in actually taking that fully autonomous or shifting to a fully autonomous transaction. But we'll have to see where that turns out in the longer term.
Yeah, I think we're not quite there on fully autonomous. But, I think, my observation from this holiday season was that users were using and leveraging agents to get ideas and inspiration and understand what should I buy? What's on sale? What's similar? What's a great gift for this type of person. I read quite a bit of commentary about that, that maybe this idea of going through the store and just browsing around for promotions, or especially on Black Friday when it tends to be a zoo, some of that traffic was rerouted online, and there's this similar workflow of engagement with the agent. I think my guess is that consumers like shopping. They like feeling that control and wanting to pull the trigger themselves. Maybe with things that are more commoditized and less personal, there may be a market for autonomous shopping in the near term. Like, maybe it's food, or maybe something like very standard.
Right. Simple commodity kinds of things. Yep.
Yeah. Things that are to me, a gift is something very personal where you actually put some thought into it. But sometimes, you're like, okay, I've been giving this gift now every year for 20 years. I need to keep mixing it up. And it's like, I think the agent can be a great source of inspiration for giving something that's even more thoughtful.
Sparking ideas in one form or fashion. Well, it is also something that we were seeing. You're talking about the bifurcation of the consumer segment. It is something where there has been, those that are the digitally demanding clients are the ones who are spending more. So, hey, I guess it's a question as to whether or not that's a segment that continues to accelerate based on digital engagement and where that happens to go. I'm curious what's underneath all of this agent and AI action, of course, is what's powering it. It was interesting to see the kind of the whipsawing in sentiment that's happening where, we're seem to be shifting back and forth between the AI is going to be huge and amazing to, oh no, it's a bubble, and back and forth. And it does seem like NVIDIA's results are basically just, hey, we're staying the course. Things are, chugging along. We keep moving forward. It seems like we're maybe AI is back in the market's good graces at this point.
AI's in a tricky spot at the moment when we think about the long-term investment thesis on it, because it's really moved a lot. And so what it needs to do something. It needs to solve a problem. It needs to have a meaningful application. Now, agents are widely viewed as the next generation of applications in the market. The challenge, though, with that is that the data centers themselves need to provide lower cost compute. They need to reduce the amount of energy that they use, and they need to optimize how efficient the output can be. And I think we're not quite there yet with it. As we've talked about in the past, they consume a lot of energy, and also inferencing is very expensive. So having that output really deliver a high quality experience that is with a level of accuracy that is needed by that particular persona and domain remains somewhat challenging depending on the complexity of what the agent's actually doing. Now, if we're talking about simpler things, I think we are starting to see some traction, as we talked about with Amazon. I think that some of the AI applications there are starting to come to life a bit. And, you're seeing users resonate a bit. But I think when we're talking about things like enterprise-wide agents or agents that are autonomously going to do things, it's, we need a little more time and infrastructure and energy, quite frankly.
Well, and that's something that you actually make a really important point that Alex Johnson was just raising in the previous episode about this evolution towards greater efficiency in AI and using, not using a, trillion parameter model for, figuring out how to make toast. It's that next stage of actually making sure that you're using models are the right size in order, for whatever task. But as you point out, it's still early days. We're still figuring out how to optimize an AI and manage that better is a challenge. I mean, one of the things, the team was at Amazon's AWS Reinforce, their technology conference, the first week of December. They were talking about now, specialized silicon that doesn't use quite as much power as a GPU about this massive set of data centers that they've built for their specialized silicon, the Trainium devices they use for Anthropic. And some of the things that they're starting to do there to tackle exactly those kinds of problems. But demand for the regular data center stuff still seems to be pretty high, and there's a lot of movement and a lot of momentum there.
Indeed, and this is what we hear from Jensen Huang. He was just at CES this week talking about the strong demand. Vera Rubin is now in production, and that is supposed to use 6% less power. It's projected to increase the performance 10x. So I think, does this move the needle? Potentially. These are things that we're watching. And ultimately, I think some of this stuff is what is moving the estimates to grind a bit higher. There's a thesis behind it that is continuing to remain positive.
Well, and it's also having impacts on a lot of the ancillary supply chain elements that are part of this as well. You mentioned Jensen's comments about Vera Rubin. One of the things he was identifying is that they can potentially simplify the amount of energy and equipment that's required for cooling by using higher temperature water. And holy cow, if you happen to be a maker of a chilled water system, it was a tough day when he started talking about that. But it starts to open the door to maybe one of the bottlenecks in building data centers. That simplified supply chain, you start to minimize or reduce some of the elements that you need in this. There's possibility around that. It is, as you're pointing out, this evolving conversation about what's involved and what are the realities. And of course, when do we get to the point at which we actually are seeing delivered value and delivered value at a scale that is going to account for the kind of capital that's being put into all this?
Indeed. One aspect of that we spoke about in your last podcast was around memory. And, we've just continued to observe high bandwidth memory, continuing to see upward revisions. Consensus for that space has moved higher. And that is essentially driven by higher demand, higher prices. And there doesn't appear to be any slowing in that. And, around that whole framework is just an ecosystem where CapEx of investing in the data center and investing in accelerated computing is just continuing to move higher. Based on Visible Alpha consensus, for the top 5 companies, the biggest 5 hyperscalers, we see an aggregate of $500 billion in CapEx coming in next year.
That is just a stunning
staggering number, right? That's astonishing. And especially if we pull it back to like 2019, because in 2019, it was around 80 billion. And now to see it at an expected 500 billion is like just an unbelievable explosion of cash usage. So I think it starts to present these really interesting questions for shareholders. Like, is this, are shareholders okay with this use of cash? Because they're not getting dividends, they're not getting share buybacks with that cash. They're getting essentially a future story. They're getting future growth. And one of the criticisms of the space is that the investment community hasn't really benefited from this ramp in CapEx in the, say, past 12 months, because the pace of the CapEx is so much higher than the pace of revenue growth. And so it's like, when do we actually see the CapEx slow down and the revenue growth tick up to a level that reflects the level of investment? And I think that's really the tension that we feel in the market. That's the current debate.
Well, I wound up seeing The Wizard of Oz when I was out at reInvent. And I think as Dorothy said, we are not in Kansas anymore. This is.
I gotta click my red shoes.
There's no place like revenue. There's no place like revenue.
No place like revenue.
Well, but yeah, it does mean that this is because again, the hyperscalers are all in the mode where this is necessary investment. We got to be able to get there, to be able to remain competitive in this next stage of AI. You have to have the capacity to be able to manage all this. You've got a whole new class of potential participants in this market, the neoclouds, the CoreWeaves, the Vultures, Constant Company, those sorts of folks. It is a very different landscape here. I don't think I'm seeing any rainbows yet, but the emerald glow of the returns in all of this are not there yet. But of course, there is the promise that they've got to be spending at these levels in order to get those returns. So yeah,
indeed. And this coming earnings season is going to be really an interesting one because for most of the companies, it's the end of the fiscal year. And the companies will give guidance for this next fiscal year. And I think, as I mentioned, I think we are at this, kind of interesting nexus point where there's a camp that feels, the TAM is sufficiently priced in, but then there are those that think there's still a lot more growth to come. And so it'll be interesting to see how the companies guide the market, what sort of commentary they come out with, and how this impacts the overall AI trade in general. Because as we've started to kind of creep into this year, this full week of trading, we've seen a broadening out in the market. And then starting last year, we did start to see some movement away from the US because so much of the index is driven by these mega cap tech stocks. And so if we see some rotation out of mega cap tech into the rest of the market and into other markets outside the US, it really changes the dynamic.
So it seems like, especially when we take a look at some of the macro uncertainty in terms of where we fit right now, it seems like that's, I don't know. I guess we'll have to see whether or not that shift continues, whether or not the rotation is something that persists as we roll into this.
Indeed. Natural resources is becoming a bigger issue, bigger topic. This is where your energy thesis is coming into play. But just simply looking at the performance of different markets, the U.S. was up nearly 17% last year, which is solid performance, but it underperformed emerging markets significantly by almost 2,000 basis points. So, if you were a holder of emerging markets versus the U.S., you would have had enjoyed a lot more upside. Both markets did okay, but it's a matter of asset allocation. Like, where do you want to be? What do you want to be getting? Risk return. And so I think this may be a question that a lot of investors are asking themselves. It's like, okay, we've been in this environment where these stocks have performed well. NVIDIA has driven the U.S. market. We have this strong dollar. How much bigger are these going to become? Is NVIDIA going to become a $10 trillion company? Is the dollar going to just continue to take the yen lower? Is it going to go to 200 yen to the dollar? Is the euro and the pound going to be at parity over the next 18 months? Some investors may be saying, wow, maybe it makes sense to diversify. And so from that perspective, even though the AI themes and the AI investment are still in place, they may be looking at other markets from an investment perspective to play these like natural resource assets, whether it's rare earth, whether it's metals, whether it's energy. A lot of this stuff is not actually in the U.S.
And there are opportunities. Again, it's as we get to January and there's that moment to, everybody's catching their breath, sort of looking, doing the retrospective view. That does seem like something that might get people thinking, hey, there are many fields in which they can play. So
indeed.
there it goes.
I mean, one of the things that Jensen talked about was smaller companies. And I mean, small cap stocks have been, they've been really a drag the past at least 3 years. And it's something that in a decreasing rate environment, this may provide some additional cash flow for these companies to come up for air and really start to shine. And from his perspective, some of these smaller companies may actually provide a vehicle for driving some of this real AI application innovation that we may not really see from some of the larger players. The larger players can provide the platforms, the infrastructure, and the capabilities, but the real creativity may come from the smaller companies, based on what his comments were.
Well, maybe they're the ones that'll actually find those killer app AI use cases and really finally capitalize on this and maybe
possible
earn some of those hyperscalers some revenue. Well, there are so many different parts to that conversation. I guess we'll be looking as the quarter rolls on and see what this next set of earnings come to see how we closed out the year. But I guess a lot more to look at as we go ahead.
Absolutely. I can't wait.
Well, thank you, Melissa. This has been great. We'll have you back on to dig into the results as we start looking at the next phase of this. But certainly a lot to keep our eyes on. Thanks for being back.
Fantastic. I look forward to it. Thank you.
That is it for this episode of Next in Tech. Thanks to our audience for staying with us. And thanks to our production team, including Sophie Carr, Veronica Adeshin, and Kira Smith on the marketing and events teams. I hope you'll join us for our next episode because there is always something next in tech.